past number of months, we have seen some quite extraordinary times, obviously with COVID. And this is, I think, probably around the 5th or 6th webinar that we have hosted for clients with Alan Oster, our Group Chief Economist, back in March, speaking to both NAB Private as well as NAB Health customers. And we've also had Jackie Fernley from JB Weir, who's also been speaking about the stock markets. And in actual fact, we have Alan back on again next week as well for their economics update. Our purpose is really to help guide you during these challenging times, to support you and to help you if at all possible. To that end, should you have any queries, please do reach out to our private bankers who are there to assist. But getting back to today, really excited, as I said, to have Alex Dimmu and Scott Keck join us. So maybe if I throw over to you, Alex, keen to hear what your thoughts are on the Victorian property market.
No worries. Thank you very much, Greg, and thanks for having me, and hope everyone is going okay during these really challenging times. I hope you and your families are doing well as well. Residential property, no doubt about it, is the thing that's still on people's mind. DIY shows that we're constantly seeing things like the block, and it really does come down to the value of Australian housing sitting at $7.2 trillion. That far outweighs commercial real estate. $7.2 trillion is made up of just over 10 million properties across the country. So again, the importance of residential property, and I know that a lot of people on this call, every other person you talk to these days is doing something in regards to residential development at the moment. So a really interesting space that we're in at the moment. It's always a good opportunity to have a look at what's happening around the country. And you can see there, our focus today is around Melbourne and regional Victoria, or Victoria more broadly. You can see for over the past 12 months, it's really since the May election last year, and I know a lot has happened since that period of time. We've had bushfires and obviously going through COVID at the moment. But you can see over that past 12 months, 11.7% growth in Melbourne, which has been a really strong return to that double-digit growth that we experienced for some time. And you can also see, and it would be remiss for me not to mention where you are today, Greg, up in Sydney, 14.3% over the past 12 months also. And I really think it has been a Melbourne-Sydney story for over 10 years now. And I think that I continue to see some good, strong growth over that 12-month period. We sort of look at the last month. Yes, there are different times to what it was in May last year. Notwithstanding, though, I think the markets have been really robust and resilient. When you look at Melbourne, just slightly at 0.9%, still shows you some good characteristics around the market and what we're seeing in the market day to day, and the transactions that we're seeing. That they're still being carried out even during these sort of unprecedented times. Regional Victoria, and I know that there will continue to be some opportunities in and around the regional Vic areas, and that has continued to see some consistent growth in that period over the last 12 months, 4.3%, and even over the past month. As working from home will change, and people start thinking about what they will do going forward. That market has remained fairly stable at just over, pretty much on parity month on month. So a good one to watch there. Auction clearance rates, no doubt about it. We saw them fall off a cliff because obviously, couldn't even attend auctions in the Melbourne and Sydney market. But we've definitely seen them return to pre-COVID levels over the last few weeks. Yes, I understand there's been a lower number of auction numbers as a whole. But it has been good to see that renewed confidence coming back into that Melbourne-Sydney market in particular, which has been really encouraging from a market perspective. We'll just focus on Melbourne house prices. As mentioned, the home values have decreased by just under 1% for the month. Very similar for the quarter as well. But again, just really is emphasis on the growth that we've seen over the past 12 months. And that's led by houses increasing by 12.2% over that same period of time. And units, which does include, the villa units, the walk-up flats, townhouses, has increased quite substantially at 10.6% over the year. also as people start looking to downsize, empty nesters, etc. So some positive results considering the environment we're in at the moment. I think it's always interesting to sort of see where we're seeing this from a segment perspective. There's no doubt about the upper quartile has seen the strongest growth in the past 12 months, and you can see that they're at nearly 14% over the last 12 months. We have seen over the last quarter a bit of a correction at 2.1% for the quarter, and on the month just above the 1% mark. But understanding that there has been limited transactions and limited stock on market. So that number will fluctuate slightly, and I do purposely have some sales to sort of go through in the latter part of my presentation, just to sort of highlight this a little bit further. You can see there the middle and lower quartiles have been a little bit more stable, but again haven't really seen that growth that we saw in that middle and in the upper quartile that we experienced. So those middle and lower quartiles at this stage tend to be a little bit more stable, and a few more transactions in and around those markets also. Again, just to probably bring it down another level, again, you can sort of see the different regions that we've started to see, potential corrections in markets. But again, you look at the annual change to the right-hand side of the graph, and you look at the left-hand side, more the quarterly movement. Again, some coming off some pretty high numbers, coming off some high growth. And again, it's not all doomsday. It's just giving an indication of the market where we're at. Transactions have come off slightly, and when you've got the lack of sales, sometimes they do throw out stats just that little bit. But it's also encouraging from the lower part of that chart. You can see, Mornington Peninsula's held up pretty well. And also the west of Melbourne and the outer southeast as well. And again, that's really comes down to that affordability aspect, more so in the western corridor and the outer southeast corridor. And that's been so I think there's some further opportunities in that western corridor that I'll touch on a little bit later also. The reason why I sort of bring this map up is for probably two reasons. There's no doubt about there's constant discussion around housing affordability issues in Melbourne. And I know that probably a lot of people on here where potentially the kids are looking to get into the market, they're probably saying, yes, it's a very expensive market to get into. But when you look at those, I'm not sure if you can see it too well on there, but that dark magenta purpley colour, that's the median prices of $1.4 million plus. And you can see those rings there, the 10-kilometre ring, 20 kilometres, 30 kilometres, etc. It gives you an indication of where predominantly the value, or the higher value properties lie within the Melbourne region. Again, the reason I show you this is if I provided you the same map in Sydney, to buy a house with a median price of under $1 million, you'd be 40 plus kilometres away from the city. Where Melbourne still gives you that opportunity to buy into, western corridor, as I mentioned before. You can be 15, 20 kilometres away from the city and still buy yourself a property sub 800, even sub 600 in a lot of cases, which continues to be the compelling opportunity for a lot of people that are coming to Melbourne. Interstate migration continues to be strong, other than the current environment we're in, because they see Melbourne as a far more affordable prospect than a Sydney. So again, just continues to sort of show, yes, there is some housing affordability concerns potentially, but in contrast to Sydney, Melbourne does have very much a value proposition in regards to the opportunities that exist for prospective buyers. I guess just in summary for what we're seeing in Melbourne, no doubt about interest rates being as low as they are. A lot of people are thinking, what else do I do with my money? I put it into a bank. We're probably not going to get too much from an interest rate perspective. So put it into the bricks and mortar. And that seems to be a common theme now for some time. That just seems to be where we're going to see continued opportunities and why people are getting into the market. June unemployment, yes, we've seen an increase in that month on month, but as we've seen, as the restrictions start to ease, people getting back into the workforce in the retail, hospitality sectors, I think that will start to stabilise somewhat. There's no doubt about as well, we're seeing a lot of expats returning home and buying up. where's the best place to be in the world if there's a health crisis, which there is, and that's to be in a country that we're lucky to be in Australia, where you've got great health services, and a lot of the expats that are returning are definitely buying up into areas and making up a little bit of the void that has been left from some of that overseas investment as well. Again, in regards to clearance rates, definitely seen them respond quite strongly in the May-June sort of period. And I think just on the clearance rates, I think in the past we've always been very much weighted. If we see clearance rates at 80%, the market's absolutely boom. On the flip side, if we see that the clearance rate reduced, then all of a sudden that there's challenges within the market. But I think we really need to be mindful as well that the new norm, we've started to see a lot more of that expressions of interest campaigns coming in that have been really, really successful. I think the online auctions probably didn't work as well in a market like Melbourne, but I think that's just something we really need to keep a close eye on, that the expression of interest campaign that's been quite successful in a lot of locations in Melbourne is not going to put as much focus on that clearance rate that we've always had. As I mentioned, while we've seen prices remain fairly stable, is for that main reason. 20-odd%, 21.3% lower in new listings, same time last year. And you can see the overall total listings have dropped over the same period of time at 20.5%. And that continues to be one of the main drivers of why we've seen markets and values remain fairly stable. Good to see some activity come back up in May of nearly 20%. After that fall in April, but again, some encouraging signs that we've got some life back in the market. That's for sure. Melbourne vacancy rate again, it's at 3.1%. We've seen that rise slightly from the 2.8% in April. The vacancy in the Melbourne CBD is probably the more challenging one. The last look at that was at 9.3%, which is quite substantially from May 2019. Again, that has been very much driven around the tourism, international students, retail. A lot of people that used to want to work closer, live close to work, potentially now are exploring other opportunities outside of the CBD with the flexibility around working from home, etc. So it'll be an interesting one to watch that space. No doubt about it, the JobKeeper, the lender's deferred home loan repayment support, ends in September. So it'll definitely be an interesting one to, watch this space. How will the market respond with some additional stock coming to market? How will the market respond with potentially a few more motivated vendors? These are things that we'll just need to track and watch quite closely. And again, the home builder grant scheme, that I know there's already been some feedback from developers that it probably didn't go as far as it probably needed to. But I think there's no doubt in a state like Melbourne or in Victoria, there's no doubt that home builder grant scheme will be taken up and is anticipated to be well received in Victoria. I know we most times have disclaimers in regards to packs that we're providing. There's no different for this. Almost at the moment, if there's a second wave, and hopefully we get on top of it in Melbourne, a return to restrictions, a second wave would definitely be something that we'd need to keep a close eye on, and something that I guess we'd need to revisit our forecasts and the perspective of where we thought the market would go. But hopefully we don't see any further spikes in viruses spreading community-wide at the moment. So just one to keep a close eye on. I think stats are all fantastic, and I think that's always good, but I'll just go through a couple of sales, understanding I've only got a few minutes left to go. But this one here just gives you a really good indication. If you're a first homeowner, health services, you're in construction, looking to purchase a first property, you're an investor, or you've been renting for so long. If you can buy a property and pretty much pay the same as what you're going to do, and buy yourself a property as what you're paying for rent, why not? And this is a good example. And I've purposefully selected sales that have all transacted in May and June also, just to give you an indication of the market and the transactions that were taking place during this period. 585 in middle of May, similar property. I buy probably inferior view slightly, but still at 551. So a good result there. One in Clayton, and this is probably a good example where we're probably definitely a development site for a dual occupancy type development. 1,045,000 early part of May. Similar property on just over 700 square metres of land, number 38, sold latter part of last year for exactly the same figure. And this is where we've seen in previous drop-offs. These are the ones where developers of dual occupancy sites tended to walk away from. But at the moment, a lot of people are leaving their money, buying the property, keeping it rented for the time being, getting their plans sorted to potentially start building in the next 6 to 12 months. Forward North, another good example here, and this is the expressions of interest that I've been talking about. Selling range of 175 to 1.9, over 800 square metres, relatively flat land. It's something that's definitely going to be knocked down and built again. 7 registered offers on the expressions of interest campaign. So again, 7 envelopes that came to the agent on that set day. That's the issue at the moment. There aren't 6 other properties for those individuals to go out and buy in Balwyn North of over 800 square metres of relatively flat land, and that's going to be the continued challenge with the stock being as low as it is. How does the market actually, the sales at the moment and the volume at the moment on the market is being absorbed by purchasers quite quickly. Another one in Egremont, another example in our northeastern location. $2.2 million, selling range of 1.85 to 1.925. 4 genuine bidders, city skyline views. People have purchased this. We'll put someone in there and build in the next 2 to 3 years. This has only occurred a couple of weeks ago, so it gives you a really good indication of where we're at from a market perspective. We don't like to forget Geelong because we see an extension now of Melbourne Metro. But this one here, property was on the market for only 3 days. It was a Melbourne buyer, sold his property in West Melbourne, 2 other local bidders. I know it's at the lower range, but we've seen some really, really consistent volumes and valuations that are coming back from that sub $1.5 million in that Geelong region. And again, this just gives you an indication of people now potentially looking at an area like Geelong, or people up in Ballarat, Bendigo, thinking I can go down to the city 1 or 2 days a week as we enter that work from home revolution that we're all undertaking at the moment, and something that I guess will continue to see some really good positive examples of this coming in some of those regional locations. I'll just finish off with one more in a Canterbury, a higher, probably slightly higher price. Again, reserve price at $365, sold for $4.12 million. Great piece of dirt, period dwelling, and again had some really strong, genuine bidders. Had an offer prior to auction. They took it to auction, and obviously far outweighed their overall. Their expectation on the day. So I just wanted to leave you with one thing though, and that's really, the motivated vendor. And this is one that I think we just need to be careful of, and just to start to see this as we do near, where JobKeeper potentially will sort of fall to the side. This one here was an online auction, didn't really perform that well. As I mentioned, Melbourne probably didn't take up that online auction too well. Was on the market for 1.6 to 1.75. The agent did advise to maybe pass it in and negotiate. They believe they still would have got well above the 1.6 mark. But again, a motivated vendor who was already committed elsewhere and had some other opportunities, decided to sell, and that's just one interesting thing that we'll need to continue to watch in the latter part of this year. But thank you very much for that, Greg. I'll pass back over to you. Thanks.
Yeah, no, perfect. Let's just make sure I've got it off mute. Thank you, Alex. Awesome insights. I really appreciate that. Folks, we've got about 110 people on the line, and we've had quite a lot of questions before this, so please bear with us as we work through it. We also have the opportunity for live Q&A. So if you do have any questions, on your screen you should see a Q&A button. Just hit that. Type your question, and either myself or my colleague Gavin Lynn will pick it up. So we're also keen to not just give you the NAB view in this webinar, we also wanted to give you the market view and a specialist view, independent specialist view, and we've invited Scott Keck from Charter Keck and Kramer, the chairman of Charter Keck and Kramer, along as well to give us his thoughts on the property market in Victoria. So welcome, Scott.
Thank you,
And
Greg.
if you don't mind, we'll go through your presentation, and then Gavin and I will have questions for yourself and Alex thereafter.
Thank you very much, Greg, and good morning to all of the attendees. Just a few minutes. In some respects, I think it's rather refreshing to find ourselves in an environment where the residential market is not racing ahead out of control, and we're all suffering from anxiety that we and our kids are going to miss out. It's actually slowed down a bit. Prices haven't really demonstrated any significant falls. And in one sense, there's a bit of breathing room. So it's probably overall not a bad prospect as a fresh change. I just want to make a couple of macro observations that I think put Melbourne particularly and Victoria into perspective. The first one is that in the Australian context, Victoria is a rather unusual state because it has a very large city, equally the largest city in Australia, but because it's a very small state, the regional centres tend to behave like suburbs. Areas like Gisborne, Woodend, Kyneton, Kilmore, Bendigo, Ballarat, and so on, they feel the economic and social benefits of Melbourne being such a big city, but you don't find this in the other states of Australia, either for the reason that in New South Wales, although Sydney's a big city, New South Wales is a very large state and the topography is different and the regional centres are relatively cut off from the CBD. And in the other states, the cities aren't so large and the states are quite big in any event. So in the national context, you've got this rather unique situation in Victoria that benefits the regional centres, which operate in a more directly in harmony with the CBD itself. That's one point. The second point that I think is worth appreciating around the issue of the current residential markets is that we all too often hear it expressed in the media that prices have fallen by 10% or they might fall by 15% or something. I always find that unfortunately misleading, because whatever variations there might be in values, whether they go down or whether they go up, it's simply not uniform and there's no single number. I mean, it varies from category to category, established housing opposed to apartments, opposed to townhouses, opposed to vacant allotments. And more particularly, it varies according to location. And it's probably no surprise for everybody to understand that in most other cities around the world, and particularly in Melbourne, real estate values are more stable and higher in correlation to the socio-economic catchment of which they form part. So simply expressed, in Melbourne, if you look at our high-value inner urban residential suburbs, such as Toorak, South Yarra, Hawthorn, Brighton, Armidale and so on, where the socio-economic profile of the residents and the owners is fairly strong and resilient to economic impact, it's no surprise that those values remain pretty stable. And that's also in those inner urban established areas, population growth is not so significant an impact on the values in that area, nor are foreign students. Really, the greatest impact comes from demographic change and household formation. And so if you look over the last 3 or 4 months, it's no surprise that in inner urban Melbourne, value levels have been very stable. And although there have been a few number of sales because of the transaction difficulties that COVID-19 has presented, there's very good evidence that the values have not fallen. So if you read in the media that someone's predicting house price falls, you just want to reflect and say to yourself, well, maybe, but where is that going to occur? It's not going to occur in the inner suburbs. On the other hand, if you move in the residential context way out to the urban fringe, where the values are different and certainly generally, from a general perspective, the socio-economic profile of the homeowners is different. it's understandable that a lot of those owners further out have higher mortgages on lower value properties. Their households would be more vulnerable to income fluctuation, particularly if two adults in the family are working. And so if the economy does dig deeply, and if some of those impacts are that unfortunate, well, you may see some price falls in those peripheral areas for that reason. But again, this is not something that is uniform across the metropolitan area. Now, I just have a couple of comments that I'd like to put up by way of a presentation, just a couple of slides if that's able to be put up. Otherwise, I can just speak to them. These are just some dot points that are reasons for our firm being confident that the residential market in Melbourne is pretty resilient indeed. And let me go through some of these points. We hear this unfortunate rhetoric about China at the moment, but can I assure you that there are economic and other socio-geographical imperatives as to why the relationship with Australia and China will right itself and continue on in due course. And in turn, what will happen as that occurs is that immigration will return and population growth will return and foreign students will return. And for a whole lot of reasons, which I won't go into today, but we at Chartered Kramer forecast that we will see a lot of that return gradually over the next 2-year period. Now, 2 years is a bit of an interruption, yes, but it's not forever. In fact, it's a relatively short time in the real estate investment spectrum. So one of the underpinning macro fundamentals that gives us reassurance about the broader residential markets, not only in Melbourne, but Victoria and Australia generally, is that we will see our population growth get going again. It's an economic imperative for population to grow, to increase our economy and strengthen our GDP. So don't fear that that's going to be an absent impact from our markets for long. It will return and it will resume its favourable impact on the broader residential scene. Some people were very concerned if they were residential investors in apartments, that vacancy rates were going up and rental values were coming down. And one of the reasons cited for this was that a lot of the short-term Airbnb accommodation, which wasn't being used because tourism had fallen away, was coming back to the residential market and competing with the more long-term accommodation in the rental market. Well, already that's very quickly started to go back to where it was before. Domestically, as the borders come down and as Victorians are keen, and Australians generally are keen to have a holiday, domestic tourism is picking up very quickly. And over the next 4 or 5 months will be really booming. And in line with that demand, a lot of that Airbnb accommodation that came onto the long-term market is going back to where it belongs, into the shorter-term market. So that impact is fading away as quickly as it came on the scene. Also on the issue of residential vacancies, for those of you that have residential property that you have invested in and you rely upon the rental income, you will find that the unusually high record high vacancy rates that we've got at the moment as a result of what has occurred over the last 3 or 4 months will decline back towards normality, and rental levels will stabilise as this lower demand is in fact offset by lower construction commencements, and this is already occurring. Don't underestimate the ability of the market to keep demand and supply always aware of each other and always heading towards balance and harmony with each other. There isn't really, it hasn't been a history in residential property in Melbourne or Sydney, and particularly in Melbourne, where you've ever had a prolonged and damaging oversupply or lack of demand. There's always been a reasonable harmony there and a predictable roadway to follow. Another interesting macro support for residential values is that when you think about affordability, we know that there are a lot of people that are on the edge of affordability and they just can't quite afford to buy. Yet don't believe that the dream of home ownership has been given up by a lot of Australians. Everybody that doesn't own a home would still like to do that. Now, if values do come down a little bit in certain areas and by certain amounts into certain areas, that will trigger an opportunity for a lot of people who were previously on the edge and outside of being able to afford to buy, to actually be able to afford to buy. So there's a big pool of potential purchasers there that will engage and participate as soon as they sense that the trigger level and values have come off just sufficiently for them to engage. And that's also driven by the fact that in the low interest rate environment that we're now going to have for quite some time, as mortgage payments, and you mentioned this before, Alex, as mortgage payments get down pretty well to a par with rental payments, it's a lot easier for people to make that decision to buy than it is to stay renting. So there's a fundamental underpinning logic that values wouldn't need to fall much in Melbourne before they were scooped up and picked up and underpinned again by people that were previously not able to buy. There's also going to be an overwhelming general return of confidence in the domestic economy as the state borders come down. And this has already commenced. We're already starting to feel it. We know the federal government is very keen to motivate all of the state premiers to get on board with this. Certainly as a community, we're facing some sort of risks with COVID-19, but the economic imperative is overwhelming. And a lot of what has been impacting on the economy and causing people to think perhaps about real estate values is fast disappearing as the domestic economy starts to get its engine room firing again. And when we talk about population growth and immigration and foreign students as being a driver of demand, and that's temporarily interrupted, I want to emphasise that those factors don't drive all markets. As I said earlier about the inner urban residential market, demographic change, the changing needs of our existing population, the age of our existing population, the household and changing household formation of our existing population drives a lot of the demand for property and property types in this country. And a large percentage of what drives the residential markets is exclusive of population growth and immigration. So it's not the sole determinant, and people don't need to get too worried by reflecting on the temporary interruption that we've got to that immigration flow. I think another thing that underpins the markets as well is that the very reason Australia was able to avoid the very worst impact of COVID-19 is that our residential communities are, by global comparisons, relatively low density. We do have the house and the backyard and the hills hoist. We're not like the Italian cities and the Spanish cities of New York, where they were living in hugely more dense populations where COVID-19 was able to spread. And this has actually extended and brought to global attention the reputation of Australia as a healthy and quality place to live. And we all know as Aussies that Australia is a great place. And globally, I think people have recognised that for a long time. But I think we've got a resurgent claim and recognition to being a wonderful country to live in. And I'm sure that off the back of this drama that the globe's been experiencing over the last few months, that Australia will increase on the list of priorities as an option to live, not only by a lot of Asians, but a lot of people elsewhere. And so it's no surprise that we will continue to see a return of foreign investment. It's seen as a safe haven, and I think that's something that we can rely upon. Something that people might be interested in as well, with the concerns about rental vacancies and lower population and one thing and another, there has been a change in the purchaser profile in apartments. I can tell you that about 18 months ago in Melbourne, for apartments that were being built in the city and on the city fringe and in the suburbs, the general split was about 60% in favour of investors as purchasers and 40% owner-occupiers. What's happened is that the development fraternity over the last 2 years, for a number of reasons, has shied away from building really large towers. They've focused back into more medium-sized, lower-scale projects. They know that they need to increase the specification away from the investor market, which has gone a bit quiet. And they know that intending owner-occupiers also tend to buy later into a project's development rather than off the plan as investors used to do. So this has changed. And what we've found in Melbourne over the last 18 months is that instead of being 60% investors, 40% owner-occupiers that are buying apartments, it's swung quite dramatically to 70% owners and 30% investors. But that will continue to play itself out until investor demand picks up again, and supply and demand inevitably start to recognise each other and get into some harmony. Yeah.
That's great, Scott. Thank you so much for that. Really, really appreciate it. I'm now going to hand over to my colleague, Gavin Lynn, who's the acting head of the Global Investment Desk. Gavin, we've had a number of questions, both by email, through the invitation, and also a couple of questions through the Q&A here. So maybe if you could put those to the panelists.
Yeah, great. So thanks, Greg, and thanks, Alex and Scott, again for attending today for NAB Private and our clients. We've had a few questions through. Alex, I might start with you if you don't mind. The first one's around, could you give your comment on the likely government taxation reform? Do you see this as a key opportunity to stimulate activity? Changes around stamp duty, land tax, etc. And I also noticed on the live Q&A we have one around your views on property prices post JobKeeper. So it's sort of all bundled in there. What's the government going to be able to do to stimulate or activity in the Melbourne residential property market?
Yeah, it's a really great question, and I think a lot of it does, really does depend on how much debt we're in. A lot of people are waiting for handouts. There's no doubt that there's some tax changes in regards to property stamp duty, all the rest of those incentives that have been spoken about. But at the end of the day, there is a lot of debt from a state perspective and also federally. So I think in regards to a lot of those changes, there does need to be an understanding of where the money is going to be repaid. I know the discussions from stamp duty, some of those changes and some of those incentives have been spoken about, but I don't believe that there's going to be substantial change in and around that for that specific reason, that we are in a hell of a lot more debt than we were at the start of the year, and bushfires definitely didn't assist in that either. But there will be, I think, more targeted approach and to incentivise people in certain markets, similar to the job builder. A lot of that, again, is means tested. A lot of it is, there's means around what you need to be to actually get that $25,000 incentive. I think it's going to be something that they'll just let play out a little bit. I don't think we're going to see anything as what Scott and I have been talking about. I think the market has been fairly resilient. So I think with that, I think the time they'll take a little bit more time in making the decisions on this and seeing what the greater impacts will be. And I think a lot of that will depend on, JobKeeper, those holiday payments they're all going to end in September. I don't think it'll be for all industries. There's already been discussions around the tourism industry, hospitality, and even retail to a certain extent around keeping some of those payments up. So it's really about what they determine to be the first point of call. What's the biggest opportunity to keeping the economy, keeping it going. And I think at the moment they'll just make decisions by week in and around that. What will happen to prices, post, what the people are talking about, an economic cliff, when all those payments do stop in September. I think, as we get into spring, as we start to see a little bit more stock on market, yes, if we start seeing a few more motivated vendors, if we want to put it in that perspective, and banks potentially stopping those payments and people having to maybe put properties on market, I don't think there's still, I think what we've got to remember, there's still a lot of people that are looking to buy in the market. We're seeing it from what we're seeing people saying, I just want to get in the market. I've been looking for 12 months. I had to wait up to the election because we thought there was going to be a change of government, and therefore there was going to be so many changes to negative gearing. That never occurred. So we're actually seeing people purchasing now that started looking in May last year. And I still think there's a hell of a lot of investors and a lot of people that were sitting on their hands for that 12, 18 months leading up to that election period that are still in the market. So yes, there might be a few more opportunistic buys and a few more motivated vendors. But at the same time, I think the market will stay quite resilient. And I don't anticipate any major drop-offs in that September, post-September period.
Okay, Okay, great. Thanks, Alex. Look, Scott, I might throw you a question as well. I'm conscious of time, and we're getting close to 11:45. But the questions come through. Where do you see the greatest opportunities for the value investor emerging in residential property? Conscious that you obviously can't give any advice in this presentation, but yeah, are you seeing any opportunities for the value investor?
We had a group meeting just before this Zoom started, and I was talking with 12 of my residential valuers, and I said to them, each of them, if you had $2 million to spend, what would you do with it? They all said residential property in Melbourne, firstly. And they strongly believe that in the Melbourne context, the townhouse is a midway proposition between a more expensive established house and a cheaper apartment. And the townhouses, many of them are inner urban or relatively in the mid-urban areas. And that this is probably quite a reliable, safe haven for investment returns, income and capital growth over the medium to longer term. So if you're talking residential in Melbourne, and you're talking in the range 1 to 1.5 million, either established or new, inner urban or middle urban townhouses. If you've got more money, upgrade to an inner urban quality established house. Those inner urban markets in Melbourne will remain strong. I'd also just comment that there'll be no chances of land tax and stamp duty changing. The government needs to get its money from somewhere, and taxing property is the most transparent way that the government will do it. And although they might change how they do it, the burden of taxes through property ownership will always be with us. So don't wait for any relief in that area, I can assure you.
Okay, great. Thanks, Scott. Look, another one to both of you. What about house and land packages? This one in outer Melbourne, this one's just come up on the Q&A. Hearing that demand side has disappeared. Any thoughts or comments on that?
You go first, Alex.
Yeah, well, I think that we've definitely seen lot sales definitely decrease in that urban growth or urban fringe locations. We're seeing a hell of a lot more incentives and rebates enter back into the market from developers or builders, which is the first time we've seen some pretty substantial cash incentives in and around that. To Scott's point that he made earlier, at the end of the day, the Australian dream of buying a property, yes, a lot of these, is there probably a little bit more stock at the moment during what we're going through COVID-19? Potentially. But as we sort of get to the latter part of the year and into 2021, I think that will be absorbed. I don't, to Scott's point, I don't think there'll be a demand issue for this type of property. A lot of developers that we've been catching up with in a larger scale, it's business as usual. They might be, their stages might not be rolled out as quick as they probably once initially were, but they still believe that, looking at the longer play, I think that's what we've got to do. We've got to sort of get out of what's going to happen in the next 6 months. And I think the developers are putting that in mind as well. What's the longer play? What's going to happen in 12, 18 months' time? And the affordability option in some of these locations, and the work from home revolution that we're going to see. A lot of people are going to go for that land and house package, on the 500-600 square metre block of land, rather than living in a small village unit potentially as well. So I think that we'll see it'll catch up, but for the next 6 months, I think we'll continue to see a few challenges in and around those markets. Over to you, Scott.
Yes, look, I'll just add that those markets, the house and land markets on the fringe, are fairly volatile. 1 minute we get the concern that immigration is going to drop off and all the sales stop. The next minute we get the announcement of a government grant incentive and the sales pick up again. It's very volatile. If you look to the longer term, and let's say look 5 years, these markets are always in supply and demand. They have always gradually gone up in value. They will continue to go up ahead of inflation. Generally, residential values in a reasonably managed economy go up at about 2 to 3% more than inflation. So if inflation is about 2%, property is moving somewhere between 4.5% or 5%. That just flows through from all the things that have an impact on property development. So if you were a first-home buyer and you wanted to go and buy a house and land package on Melbourne's fringe, I would say to you, don't worry about the current volatility. Go and buy it. And 5 or 6 years from now, you'll be quite happy with what you've done. However, if you're an investor, I wouldn't be so keen to do that. I would be looking to try and gear my money or focus my equity into a more inner urban investment. I'd rather have a townhouse 10 kilometres from the city than a house 40 kilometres from the city.
Right. And that's a really good point. That's Daniel's just asked that question as well, Scott. What do you can constitute as inner urban distancing from the CBD? Would you say it's around 10 kilometres?
Probably, where the trams stop.
Right.
Yeah.
Do they ever stop? Even Sydney got trams these days.
Yeah.
But let's not touch on that anymore. Okay, so I think, Greg, that might be it for the questions at the moment.
Perfect. I was going to make the point that at least your trams work, number one, and at least your trams go faster than I can walk, number two. Before I sign off, can I thank Alex Dimmu from NAB Valuations. Thank you, Alex, for your time and your very insightful presentation. Scott Keck, as always, a joy. Your knowledge is phenomenal on the property market, so thank you for investing the time with us today. Should anyone wish to contact either Alex or Scott, please feel free to reach out to either myself, Gavin, or your NAB private banker, and we'll connect you with Alex and Scott. Before I sign off, what I would also like to say is that, look, there was a question asked. Gavin didn't cover it off, and thank you also, Gavin, for hosting the Q&A. Gavin didn't cover it off, and it was, are the banks open for business? Now, I can't speak for other banks, obviously, but I sure as heck know that NAB is open for business. Feel free to reach out to your private banker or your business banker or myself if you want to discuss further. At the end of the day, we make the bulk of our money from lending money out. So obviously we are very, very keen to keep the door open for lending as much as possible. For those of you who are in a degree of financial distress, please also reach out to your NAB private banker. Our job is there to help support you, to help look after you, and help guide you through these very challenging times. A question that was asked to me directly here by John was, look, what are the banks going to do at the end of the moratorium on loan deferrals? And I said to him that, look, we can't speak or comment obviously for other banks, but you know, at NAB we're doing midterm check-ins with the customers who have asked for loan deferrals, and at the end of the period, the intention will be that those deferred loans will revert back to their payment schedules again. Now that is the plan, and that's our intention at the end of the loan period. However, that's a topic that's up for ongoing debate and is being debated by the bank's executive leadership team. Currently, the plan is that those loans will revert back to their payment schedules again. What I would also say to you is that this isn't just a financial crisis. You know, speaking to people, this is also a well-being and mental health crisis. And again, if you do need to speak to someone, I would ask you to reach out and speak to those around you. We at NAB provide our customers with counselling sessions from a company called Benistar. If you want to know more about that, if you feel that that would be of benefit to you, please reach out to your NAB private banker if you need to discuss that. Or if you want to reach out to me directly, I'm more than happy to point you in the right direction. So once again, thank you to Alex, thank you to Scott, thank you to Gavin for your fantastic hosting, and to Bree for pulling this all together. And thank you all for investing the time with us today to listen to our panelists. Once again, thank you from Sydney. If I had my way, I would live in Melbourne, but my wife wanted to live in Sydney. I'm actually quite depressed now, having listened to Alex, given the fact that Melbourne appears to be a heck of a lot more affordable than Sydney. And we have another one of these tomorrow with the Sydney clients, so that should be quite interesting. So thank you all for your time. I look forward to catching up with you all soon. Thanks.
Thank you, Greg. Thank you, everybody.
Thanks, everyone.